So we start off with an interesting topic on multi-baggers, right? So I think Geetik also almost set up the platform for, the presentation and spoke of multi-baggers as well. And our view has been that, if you need to deliver performance on the overall portfolio, right, it's about delivering it at a stock level, right? And that's where we give a lot of importance to it. And multi-bagger, interestingly, is a process that we've created, right? So having come from Wipro, I think I like to put a process to everything. So a lot of our investment journey is a process. And then we said, okay, some of these are working. So how do we make that also as a process? And I'll share that process also with you as we sort of go forward. So if I think any of you are investing in stocks yourselves, I think that is something that hopefully will also be useful for. So the starting point of multi-baggers, and I'm start from the basics, is actually to catch the trends, right? So right from the macro itself, and you see the macro trend for India, the per capita GDP going up. Even if you see, there's a shift to higher income levels, and that also, non-discretionary spending, etc., things that come out there. And broadly, if you look at it from how things have moved in sort of more developed markets, how as the GDP of the country keeps increasing, actually how it goes up to more and more wants, from wants to or rather from needs to wants is where things go. And broadly about the second part of it is looking at trends in the sector. Okay, and I think that's something which there was a whole lot of movement on sectors that happened right from defense now out of favor in the short run. Okay, similarly, we think renewable energy is something which is something of the future out there. I think there's a lot of data out. I will try and keep my presentation a little shorter because I want to do a few questions. Okay, and there's enough and more about why renewable energy. I don't think I have to explain it to you, but there are few companies there, and so how do you sort of take advantage of some of them? Okay, but the other part of it is about apart from the macro, the sectors, I think coming out to looking at contrarian calls, also looking at value is something that sort of can make a lot of sense. And you had REC at a crazy PE multiple of 3, right? And it was steel. So at that point of time, probably everybody was shunning it away, which is why you didn't have the multiples much higher than that. But at some point of time, that turns and that changes, and so if you're able to get the timing right, then definitely sort of it's good for you. So value also, as well as taking contrarian calls, can be an interesting one. And that's something that we also do at an overall level. Even if you look at it as a strategy, contrarian has been one of our styles. And I think we spoke of March 23 when there was a lot of, the crisis around SVB. We had Adani in India. We also had the SVB thing, moving on to Credit Suisse and stuff. RBI was hawkish. And so end of, around March 23. And that was a time when we took a bit of a contrarian call even on the market itself. And because we studied, the banks in the US, because, that was a risk that was around the horizon. And then we realized that, okay, it's not showing up in terms of, the broader banking index for the US, right? So, and then we came out with a contrarian report. Interestingly, we said that in the next financial year, in Outlook, we said that we think markets are, Nifty will deliver 15%, and we gave a buy call on mid and small caps, okay? And that's something which really did well. We, in fact, subsequently started off a small cap strategy, a small cap variant, and something like March to about August, it ended up delivering some 42% return. So the point I'm trying to make is if you're able to get the timing right, and when everybody is negative about it, I think that's the time that you can also make good money, and not only at a stock level, but also in terms of points of entry as well. Okay. The other part of it is looking at stocks which are in the growth mode. Okay. I think that India is a great country on the growth side, right? So, and I think growth stocks are the ones which drive in the long term. And I think you look at Trent, for example, that's also been something that has done reasonably well for us, 7x in terms of return. Okay, but even as late as maybe last year, when people looked at Trent as one of the top stocks in our portfolio, people are coming back and saying, but isn't it overvalued? Right? So some of these are engines which grow really fast and continue to grow fast. Of course, it's also important to look at valuations, and that's something that we also normally look at. And there are a number of stocks where when valuations have really gone excessive, we've pulled back and got out of them. But definitely, finding a growth stock is something which will help you also get a good multi-bagger. But I think most importantly, I think it's boring things that do well, right? So again, we created a whole process to things. The whole investment journey for us, we broke it up into a 4-step process, and I'll spend some time on that. But making it boring, making it repetitive, and doing the same thing again and again, I think is what I believe actually ends up delivering better returns, because the devil is in the detail, right? And so this is basically the whole process of right from screener, where we come to a set of 125 stocks, and then we also do from there, we do a bit of a ranking of all those stocks. Okay, so which is our scorecard. The second step in that is then we go deeper into looking at each of those companies from, because what is happening, what has happened in the past is maybe what a lot of these screeners and a lot of the metrics will give you, but the future is something that you need to go deeper into the stocks, into what are the parameters that you think will grow. Is there additional capacity? Are there tailwinds? What is the competitive advantage, the pricing power, etc. To sustain for the future. And the other part is risk. Okay, because we believe as a fund house, we would like to deliver a superior risk-adjusted return, right? And risk is a whole strategy in itself. Before we touch any stock, before we enter into anything, we do a bit of a limited forensic, and on a continuing basis, then we sort of track the risk parameters as we go forward. And the last is a pendulum, which is more about valuations, and we believe growth at the a right price is important for us, because it also helps us manage risk, apart from helping us deliver better returns. And the multi-bagger framework, basically it's a very simple one. So if we are able to get a stock which you think will have earnings growth or double earnings growth in the next 3 to 4 years, and you also think that valuation will also, and the P rate multiple will improve, okay, that's two parameters. If you put it together, okay, and you're able to achieve that, then automatically you get a multi-bagger stock, because mostly even just from earnings growth itself we should get it, but the valuation re-rating also will help deliver that bit of extra. Of course, sectors that we look at and looking at today, right from manufacturing to financials, building materials has been sort of an important part of it, our portfolio for a period of time, capital goods, consumer discretionary, and renewable energy. And actually, this has been our track record, almost 20 plus multi-baggers that we've seen in a short period of time, maybe it's about 4 years or so. Okay, that's something that has been a consistent one, and that has helped us sort of deliver the returns that have happened. In fact, like last month, we had 3 of our strategies in the top 10, of money control. And KEI, one of the building material side, the cables, okay, and 14.5x, Okay, it's also important to ride the journey, right? Because many times the temptation is to get off it. Okay, and so the point of exit also is important. It's very important to exit because things don't last forever, but it's also important to sort of ride the journey. And SuperValu, which has been one of our strategies, which is on the mid and small cap side, I think where a lot of these ideas sort of come in, has been an outstanding one, and just trying to also showcase that if you get, your stocks right, if you get the multi-baggers, then I think returns will follow automatically. Not only that, I think what gives us a lot of joy is, the risk parameters if you measure, right from the beta to you look at it, okay, and risk-adjusted return parameters, again, we are doing pretty well there. And also the underlying stocks that we hold, right? If you see the bottom table there is about, what is the parameter of the stocks that we hold and how is it versus the index? Because if that is superior, then I think broadly you end up, seeing returns out there. Okay, some other themes that we look at, just to give an example, when we are saying multi-bagger, okay, we believe that, some of these stocks are at discounts to, the peers or even to the leader out there, and we think there's a multiple re-rating, and so that's how sort of we pull in our framework. At the same time, I also want to, talk about the risk side of things, right? Because, we're all gung-ho, multi-bagger, all of it great. But I think, I shouldn't end this presentation without talking about the risks. And, especially today, there's a lot of momentum. Stocks are moving. Somebody today told me, my this year 90% IRR, okay, is what they've got. Okay, so but the point to keep in mind is, it's important to look at the quality, of the companies that one holds, because right now you may find that things are trending, okay, but when the momentum goes away, you may actually see a large fallout there. And data shows that if you see the small cap index, if you look at the bottom quartile versus top quartile, bottom quartile has done almost nothing, right? It's crazy, 2.2%, right? At the same time, if you get to the top quartile, it's been very, very rewarding. So that's the point that I'm making, that, it's important to have the right quality of stocks which can sort of sustain in the long term. And I thought PGIM did a very nice way of capturing it, which I wanted to again highlight in terms of the risk side. Okay, when you look at, they categorized stocks into quality, growth, and then they bucketed it. Okay, quality was basically which are the stocks which in the NSE 500, right, have above average ROE, right, and they categorize that as quality. And growth, they looked at whichever has above average growth, and in the NSE 500. And the interesting part is, if you looked at a 30-year period, a 10-year period, you had a 30% in quality and growth, but neither quality, neither growth was only 17%. Okay, so what is interesting, if you look at 1 year, it's crazy, right? You find quality and growth is 43. It's completely flipped. Neither quality, neither growth is 72%. And it's anybody's guess as to what will do well in the long term, right? So that's the point of caution that one wants to bring along with data, that, okay, while there are a lot of things which are running in momentum, you have to be cautious. If you get into momentum, you have to play momentum with timing, right? You have to come in at the right time and you have to get out at the right time, because you just don't want all your return to go away. So quickly, just to wrap it up, we believe that grounds up is how you build your portfolio. Okay, and well, like I said, while alpha is important, okay, it's also important to ask yourself, is it sustainable? Thank you.